The Canadian housing theta is burning out.
Right.
If you're a long-term holder, believing in that assumed safety trade.
The old mantra, buy and hold.
Exactly. The idea that you just buy and the asset inherently appreciates with time, that core premise is, well, it's rotting while you wait.
Right.
The yield is gone. The underlying asset class is failing, fundamentally failing to earn its keep.
And the time decay, which is what you're getting at with theta.
Yes, the negative theta. It's inherent in the prolonged illiquidity, the holding costs, and it's accelerating. It's working directly against the perceived safety of holding physical real estate.
So what we're really seeing is a structural failure of time as an investment advantage. Time is now the enemy.
It's the enemy.
And, this isn't just theoretical market chatter. This isn't just us talking concepts. We have hard data that chillingly confirms this failure.
From the CREA report.
Directly from the CREA report for 2025.
Yeah.
And the figures they're historically extreme.
Let's start with the biggest market, Toronto.
Consider Toronto, the heart of the Canadian financial system, right? The largest market in the country. It saw just 62,433 homes sold last year.
Just 62,000.
That is the lowest level of transactions recorded since the year 2000.
Wow.
That's a 25-year low. You have to let that sink in. We are witnessing the largest economic engine in the country just seize up, failing to transfer assets at any meaningful volume.
And the comparison gets worse when you move west, doesn't it?
It becomes catastrophic, truly. Look at Vancouver, 23,800 sales. And the report it explicitly states this, and you, the listener, need to really hear this part, that volume was lapped by the volume sold during the 2008 global financial crisis.
So wait, during the Lehman Brothers collapse?
Yes. During a period of systemic financial meltdown, when global credit markets were literally collapsing and banks were failing, Vancouver still managed to see more housing transactions than it did in the entirety of 2025.
That's an incredible statistic.
It's not just stagnation. This is a full-scale systemic failure of perceived asset safety. And it's driven, as the source notes, by heightened economic anxiety.
That anxiety.
That sheer paralyzing uncertainty.
Yeah.
That is the current engine driving volatility. That's our vega.
Right.
And it's why we prefer liquid options where uncertainty is actually priced into the contract. Real estate forces you to just eat the uncertainty whole.
And here's where the macro strategy comes in, because the domestic policy failure is it's palpable. We have to analyze the complete ineffectiveness of the stimulus that was attempted. The Bank of Canada lowered its key interest rate by a full percentage point.
100 basis points. Not a small move.
Not at all. A significant stimulus attempt delivered over 2025. And yet, that 1% cut failed spectacularly to save the major high-cost markets like Toronto and Vancouver from those crippling sales declines we just mentioned.
It failed because the problem wasn't the interest rate, was it? It was the leverage.
It was never the rate.
The 1% cut offered, a marginal reduction in carrying costs? It did absolutely nothing to address the structural debt-to-income ratios that had already reached, historical, completely unsustainable extremes in those Tier 1 markets.
So buyers weren't thinking about that 1%.
Of course not. They weren't worried about 1%. They were worried about the next 5%. They're pricing in much larger risks than domestic interest rates.
Exactly.
They are pricing in systemic uncertainty.
Exactly. But here's the thing. The data presents a fascinating paradox that reveals the exact mechanics of this failure.
The regional split.
The regional split. Because while Toronto and Vancouver were crashing into those 25-year lows, the rate cut did boost activity elsewhere. We saw this spectacular regional divergence.
Well, we need to acknowledge the structural difference there. You can't compare the two.
Absolutely. Take Quebec City. It saw a whopping 17% price increase year over year.
Incredible.
St. John's and Regina also got a healthy boost. So the monetary action worked in pockets.
Right, where affordability hadn't been completely torched.
Exactly.
Okay.
Where debt-to-income ratios were merely high, not, clinically insane, but that stimulus was completely neutralized in the major metros by something much larger and, frankly, much more frightening.
Global macro risks.
And what's the big one? The U.S. trade war risk.
That's the ultimate volatility spike. It's the non-localizable factor that you just can't hedge against locally.
The fear surrounding the U.S. trade war, coupled with the upcoming CUSMA renegotiations, that is the systemic risk factor that just overshadows anything the Bank of Canada can do with its domestic levers.
It really does.
This uncertainty is the ultimate abstract vega driver. Buyers who operate on high leverage or, who rely on trade-related income, they cannot price the risk of a major economic contraction or trade disruptions stemming from Washington.
Impossible to model.
The possibility of tariffs or trade barriers, particularly in sectors tied to construction, energy, or manufacturing, it's a geopolitical storm cloud that just keeps them on the sidelines, regardless of a single percentage point rate cut.
And because of that lingering systemic doubt, implied volatility across the entire Canadian financial sector,
The banks.
the insurers, the real estate trusts, it remains inflated. And that right there, that's the environment we need. That inflated vega is the source of the edge we are here to trade.
You're listening to Theafuse. I'm Maya.
And that's Gotham.
And we're breaking down the collapse of urgency in the North, analyzing the 2026 Canadian housing outlook not as a real estate story, but as a pure volatility-driven trading opportunity.
Let's get into it.
Let's unpack the hard transition from, market exuberance to what we're seeing now, which is market paralysis.
Let's start with the sentiment breakdown. I think this is where the market psychology finally catches up to the structural fundamentals.
It always does, eventually.
For decades, the North American housing narrative was built on an unquestioned truth. Right.
Yeah.
Buy, wait, and appreciate.
Time was your friend.
Time was your strongest ally. Your investment was non-perishable. Now we're seeing a massive negative shift, and I frankly mock the traditional housing narrative. It's a textbook case study of an asset class just dissolving the underlying assumption of its own safety.
And the source material actually has a quote from a realtor that crystallized this shift perfectly. It's a move away from FOMO, fear of missing out, to a completely new kind of fear.
Yes, and it's a fantastic quote. The realtor noted that the new fear, the prevailing sentiment in these high-cost markets, is that sellers are now thinking, if I wait 6 months, I might get less money than if I sell today.
That's the whole game right there.
That is the defining pivot. That fear is the precise antithesis of the long-term passive appreciation trade. When sellers are actively competing against time, when they're actively worried about the inherent time decay of their holding, the foundational assumption of asset safety has dissolved.
This is a perishable good now.
It's like holding a melting ice cube. It's, technically still an asset, but the negative theta decay is now visibly dripping onto your portfolio statement.
But this emotional shift isn't just about anecdotes, is it? It's already translating into accelerating downside delta risk in the transaction data. How fast is this momentum actually gaining speed?
Oh, it's accelerating rapidly, and it confirms the seller's anxiety isn't misplaced. The Greater Toronto area saw home sales drop 11.2% compared to 2024.
Okay, that's a significant drop.
It is. But look at a highly leveraged market like Hamilton. Sales in December were their slowest since 2010. That's a 12% drop year over year.
Wow, since 2010.
These numbers don't just confirm the fear, they justify it. The momentum has changed direction, and it is gaining speed.
Which brings us back to liquidity.
It underscores why housing is an abysmal asset class compared to liquid, exchange-traded options. When sentiment pivots, I can execute a contract in milliseconds.
Instantaneous. In housing, that same psychological shift leaves you holding an illiquid asset that takes months to move, forcing you to constantly reprice downwards, facing that accelerating downside delta until you finally manage to offload the risk.
That illiquidity is the hidden cost. Okay, let's turn our attention to the great Canadian data disconnect, what we're calling the tale of two Canadas.
Right.
This regional divergence is crucial because it helps us separate the systemic, the untradeable macro risk from the localized, correcting, speculative frenzy. We have to delineate the pain.
We absolutely must stop talking about the Canadian housing market as a monolith. It's just not. The experience depends entirely on which side of the affordability chasm you reside.
So on one side, we have the slow markets, where the pain is acute. Toronto, Vancouver, and much of southern Ontario.
All the places that saw that crazy post-COVID run-up.
Exactly, including the smaller cities that saw the massive multi-year appreciation: London, Kitchener, and Waterloo. These markets are structurally broken by leverage.
And on the other side, and then in sharp contrast, we have the hot markets. Quebec City, St. John's, Regina, parts of the Atlantic and the prairies, places where activity has been stable or even hot, as the source notes, confirming that 17% price jump in Quebec City.
This is a crucial distinction. The regional divide shows us exactly what capital is doing, and maybe more importantly, what the Bank of Canada's 1% rate cut was structurally capable of achieving, and what it wasn't.
It's a macro repositioning. It's a flight of capital. RBC's Robert Hogue explains this slowdown in southern Ontario as a partial reversal.
A partial reversal. I like that phrasing.
A partial reversal of the massive, unsustainable post-COVID price surge. Those secondary markets experienced tremendous growth. We're talking 40, 50, even 60% jumps in just a couple of years.
Totally insane numbers.
And because those gains were so significant, Hogue concludes, the correction is also a bit more significant. The capital that chased that speculative boom is now fleeing the high-cost, high-leverage metros. It's searching for value and, critically, searching for stability in the value markets.
So this isn't a blip.
This is not a short-term blip. This is the market correcting years of just irrational exuberance.
And we can use this divergence to surgically define our volatility risks. Systemic vega, that geopolitical anxiety from the U.S. trade war and CUSMA, that hits everyone.
Great, it's unavoidable.
That risk keeps the major bank indices choppy because credit markets are global. But localized vega is what's punishing the bubble markets. That localized volatility is the necessary correction from the speculative frenzy, forcing prices down in the areas that overshot most aggressively during the pandemic.
So when we're setting up a trade,
we have to recognize which vega we are trying to capture. Are we trying to capture the slow, systemic macro fear or the aggressive, localized correction fear? They're two different animals.
Speaking of that systemic vega, let's dive deeper into the CUSMA renegotiations. It's easy to dismiss trade wars as some abstract geopolitical factor, but it is the primary non-interest rate factor keeping high-leverage buyers on the sidelines.
It's the ghost in the machine.
So what are the specific mechanisms by which CUSMA uncertainty translates into housing volatility?
Well, it's threefold, and it hits the absolute core of the economy. First, you have to think about construction costs. If the U.S. initiates punitive actions, say new tariffs on Canadian lumber or steel, which is always a threat in these negotiations, it immediately impacts the cost basis for all new housing projects.
The input costs just skyrocket.
Exactly. Higher construction costs mean developers are paralyzed, further constricting supply. But critically, it means that even stable housing prices become less affordable relative to the replacement cost. It introduces an inflationary risk directly into the asset class itself.
So it's not just a general economic malaise. It's a specific, quantifiable inflation risk tied to one of the biggest costs in the housing sector. What's the second impact?
The labor market.
Of course.
CUSMA uncertainty targets Canadian exports. We are, highly dependent on access to the massive U.S. market, particularly in manufacturing, energy, and certain agricultural sectors. If that trade agreement falls apart, or even if the negotiations just drag on under hostile terms, Canadian companies dependent on that cross-border trade stop hiring.
They pause investment.
They pause investment, and they may even implement layoffs.
And that links directly back to Hogue's conditional floor on prices, which we need to cover in a moment. If those jobs vanish, the high-leverage homeowner who thought their job was secure suddenly faces, existential risk.
Exactly. The fear isn't about the cost of debt anymore. It's about the ability to service any debt at all.
Okay, and the third point?
The third point is the currency risk. Aggressive U.S. trade policy almost inevitably leads to currency volatility. A sudden weakening of the Canadian dollar relative to the USD makes foreign debt more expensive, and it drives capital flight,
which further destabilizes financial assets,
including the underlying value of the Canadian banks, which hold the bulk of this mortgage exposure. CUSMA uncertainty is vega because the outcome is binary. Either trade continues largely unimpeded, or we face significant disruption. There's no middle ground.
Moving now into the market mechanics. Let's focus on what prevents a quick recovery. The inventory overhang. This seems like a pure negative gamma force, a mechanic that actively amplifies downside moves, especially in these illiquid markets.
It is, and it's a concept that needs to be fully grasped by you, the listener. Inventory overhang means there are simply too many listings for the current buyer base.
Supply massively outstrips demand.
Hamilton, again, is the textbook case study. It's seeing a continuous influx of new listings, putting chronic downward pressure on prices. RBC's Hogue summed it up perfectly. He said, there's a lot more inventory in those markets, so there's less urgency for buyers to move quickly.
Right. Less urgency for buyers means exponentially more anxiety for sellers.
Especially for those who have to sell.
The ones who are forced sellers due to changing financial circumstances?
Precisely. In options terms, high inventory acts as negative gamma. Now, gamma measures the rate of change of delta.
So how much faster the position moves for every dollar the underlying asset moves?
Correct. In housing, when inventory is high, it means the bid-ask spread widens dramatically. Buyers know sellers are desperate.
They can lowball.
Any small decline in buyer interest causes sellers to start leapfrogging each other down in price just to secure a deal. That pressure amplifies the drop, that's the high gamma risk, far quicker than a balanced liquid market. You get disproportionately large quick price drops because any nascent demand is immediately absorbed by the glut of supply.
So it increases the market's sensitivity to downward price changes.
Which means the conditional floor on prices is far, far weaker than advertised.
Which brings us to the critical directional bias. This floor on prices is conditional, not guaranteed, and it hinges entirely on one thing.
The labor market.
The labor market. This is the single greatest uncertainty factor cited by the source.
It's an explicit binary bet on Canadian employment stability. We have two scenarios, and they are dictated entirely by the health of the labor market.
Okay, walk us through scenario A, the positive bias.
Scenario A. If the labor market picks up, Hogue suggests it could firm up demand and finally put a functional floor on prices. Buyers regain confidence, they start believing their jobs are secure and they can service their debt, and that stabilizes the correction.
It stops the bleeding.
Stops the bleeding. But the danger, of course, lies in the inverse.
Scenario B, the negative bias.
Scenario B. If the economy proves weaker than expected, which is a highly probable scenario given the trade war fears and the current indecision prices might fall more.
They break that conditional floor.
They break the floor and accelerate the downside delta. This is where the gamma risk we just discussed truly kicks in, and it could potentially trigger a wave of forced sales.
A weaker labor market means less consumer confidence, obviously.
But more specifically, it means rising defaults on loans, particularly on home equity lines of credit, HLOCs. When the job market weakens, the number of forced sellers increases.
People who have to liquidate.
People who must liquidate their primary asset due to job loss or failure to meet balloon payment schedules. And these forced sellers, they contribute even more to the inventory overhang, accelerating that negative gamma feedback loop and potentially pushing prices far past where any rational market bottom should be.
The conclusion here seems obvious for us as volatility traders. There is no clear directional bias or momentum.
None whatsoever.
The market is just waiting. It's paralyzed by its dependence on the uncertain labor market and the uncertain trade environment.
Hogue himself admits it. He says, "We are quite likely to be concerned about the direction of the market throughout a good part of the year because of all this economic uncertainty lingering and continued questions about the labor market and how rapidly it will improve."
That quote right there confirms it. The environment is absolutely ripe for volatility plays.
We need to bet on the magnitude of movement vega, rather than a specific direction or delta.
We should briefly address the counter-argument, though. The optimism from CREA.
Yes, which, frankly, reads like standard, mandated optimistic sales copy from the real estate establishment.
The senior economist, Sean Cathcart, suggests we shouldn't trace a line from the sales lows of late 2025 into 2026.
And he expects sales to move higher again as we get closer to the spring.
The classic spring market hope. I see that as the aspirational ceiling of confidence we need to be aware of, but not trust.
Not at all. It contradicts every single fundamental data point we just analyzed.
The 25-year sales lows.
The record inventory overhang.
And the paralyzing dependence on an uncertain labor market.
The optimism is completely detached from the very real anxiety that is currently the dominant economic driver. We note it, but we dismiss it as noise. Our trade must be based on the systemic anxiety, not seasonal optimism.
All right, now we shift from structural analysis to immediate execution. It is the morning of January 15th, 2026.
Game time.
We need to check the immediate market backdrop because the trades we're discussing, volatility trades, are exquisitely sensitive to instantaneous volatility events, particularly the dreaded IV crush.
And we are walking into the ultimate IV crush event right now. The calendar is brutal today.
What's on the docket?
Before the market open, we have massive earnings reports hitting. Goldman Sachs, GS Morgan Stanley, MSCI, and BlackRock, BLK.
The heavyweights.
These institutions are not just random financial entities. They are intrinsically linked to the global credit ecosystem that underpins all Canadian real estate lending and financing.
Let's make that linkage explicit for the listener. Why do the earnings of three large U.S. financial institutions matter so profoundly for Canadian housing volatility?
Because they're massive counterparties, securitizers, and capital allocators globally. Canadian institutional debt,
Things like mortgage-backed securities.
mortgage-backed securities, bond issues by major Canadian banks, collateralized debt linked to real estate development. It's often managed, packaged, or held by these giants. So if GSMS and BLK report benign earnings, if they show strong balance sheets and stability in their credit divisions, that signals to the entire global market that the systemic risk is contained, at least for now.
And if systemic risk is perceived as contained, if the financial sector breathes a collective sigh of relief, implied volatility drops immediately and dramatically.
Correct. 5 is essentially the premium we pay for uncertainty. If these reports coming benign and calm the global credit system, implied volatility is drained instantaneously from Canadian bank ETFs and related financial derivatives.
So if you're holding a volatility play,
If you are already long volatility, if you hold a straddle or any pure long option, a sudden drop in IV will destroy your position premium due to IV crush, even if the stock moves favorable later in the day.
so the timing is everything.
We are playing the lingering macro uncertainty, but we absolutely cannot afford to be caught holding a volatility play through an earnings release that is designed to settle the market.
And adding to the complexity, we have global inputs to consider that affect liquidity. While North America is focused on these earnings, the Indian markets, the BSE and NSE, are closed today for municipal elections in Maharashtra.
Which seems random, but it matters.
It reinforces the need for constant global awareness. While it's minor, any major emerging market being offline affects global liquidity flows, and it reinforces the idea that global decision-making, in this case political and electoral, is overriding financial continuity.
And the market sentiment itself today is utterly schizophrenic. It perfectly mirrors the indecision and lack of directional bias we found in the Canadian housing data.
What are we seeing?
Today, we're seeing a 65% up-day bias among retail and technical traders.
Okay, so a lean towards optimism.
And this is the key, the underlying expected returns for the DJIA are negative.
It was a complete contradiction.
It means traders are hopeful for a technical rebound following a tough week, but the professional models still suggest downward pressure. This split sentiment hope versus reality is what creates the perfect environment for non-directional trading. High uncertainty, but no clear momentum.
And we also have confirmation that sector-specific news can pierce this general uncertainty, showing where clear delta actually exists.
A quick note on Spotify, SBOT.
Yes, the stock is up 3% pre-market today.
After announcing a price hike. That is a clear, definitive delta move driven by a fundamental business decision, higher revenue per user.
Right.
Contrast that clarity with the paralyzing indecision in Canadian financial ETFs, which are just sitting there waiting for the earnings bomb to drop.
It shows you the value of clear directionality, doesn't it? In the tech sector, a price hike gives a definitive bias, a positive delta. In Canadian housing, we're paralyzed by a conditional floor on prices and systemic vega, with no clear business decision capable of overriding the fear.
Exactly.
Okay, time to frame the theta edge trade. Our analysis drawn from the RBC and CREA data leads to one definitive conclusion.
Which is?
Economic uncertainty is lingering. It's fueled by labor market questions and the systemic risk of the CUSMA renegotiations. The market is stuck. It's stuck between a conditional floor, a stabilized labor market, and an arbitrary ceiling, the macro fear preventing a real boom.
So betting on direction is a fool's game.
Therefore, betting on movement direction, on delta, is fundamentally inefficient and just too risky given the conflicting data. We have to bet on the magnitude of movement. We have to bet on vega.
So we execute a trade designed purely to capture the elevated volatility, the vega, inherent in this systemic uncertainty.
What are the targets?
We focus on liquid assets that are highly correlated to Canadian real estate exposure. We're targeting Canadian bank ETFs or perhaps major housing developer stocks or ETFs that offer robust options liquidity. We are trading the anxiety, not the bricks and mortar.
And you have two strategies in mind.
Two distinct, non-directional strategies, depending on your risk tolerance and your confidence in the timing and violence of the eventual breakout.
Okay, walk us through the high-risk, high-reward option, the one that requires a violent resolution to this current stagnation.
Option 1 is the long straddle. This is a pure vega and magnitude play.
How does it work?
You simultaneously buy an at-the-money call and an at-the-money put expiring in, say, 60 to 90 days.
Okay, so the immediate cost will be high.
The cost will be very high because implied volatility is currently elevated due to that lingering uncertainty. You are paying a premium for the fear itself.
So we are essentially placing a high-cost bet that the market which is currently paralyzed by indecision, will eventually choose a direction violently enough in either direction to overcome the combined cost of the two premiums.
Precisely. The justification is rooted in Hoag's two critical labor market scenarios we talked about.
Right, the binary outcome.
If the labor market either firms up dramatically and sparks true buyer confidence, we get a sharp upward move, breaking that macro fear ceiling. Or, if the economy proves significantly weaker than expected, that conditional price floor breaks, triggering the negative gamma feedback loop we discussed, and we get a sharp downward move.
And the straddle wins either way.
The straddle captures the ensuing volatility regardless of direction. This is for the trader who believes the current stagnation is fundamentally unsustainable and a massive, definitive move is due within 90 days, but is unsure which way the labor market and CUSMA will ultimately swing. It hedges the binary geopolitical outcome.
That makes perfect sense. The straddle uses the high systemic vega to capture the violent resolution of those macro risk factors. Now, what about the less aggressive, higher probability trade? The one designed specifically to harvest the theta decay from this current stagnation.
That would be option 2, the wide iron condor.
Okay.
This strategy involves selling out of the money call and put spreads with wide wings. Instead of betting on a directional breakout, we are betting on continued paralysis and choppy trading within a defined, narrow range dictated by the current fear.
So this is a pure theta harvest play. It's designed to profit from the illiquidity itself.
It is a theta positive play. If the market remains schizophrenic, just trading sideways between that fear ceiling and the conditional labor floor, the condor profits.
You're betting on the paralysis.
We are betting that the uncertainty itself acts as a brake. The macro fear keeps prices high enough to avoid a crash because no one wants to sell at the bottom. But the fear of the trade war and a weak labor market prevents a breakout.
So you sell the options in that range?
We sell options in the current expected trading range, and we harvest the theta decay from the middle of the range. We are effectively being paid for time to pass while prices are stuck. This requires high confidence that the current price floor and ceiling will hold for the next 60 days. It means the systemic risks have to stay simmering, but not boil over immediately.
Critically, we need to address the structural risk management, the Greeks, for these non-directional trades, particularly given the immediate Ivy crush risk from the bank earnings today.
Yes, we must emphasize that both of these trades are designed to neutralize delta bias as much as possible.
How so?
By pairing long and short options in these configurations, we minimize our exposure to directional movement. We don't care about the asset's direction, only its movement characteristics.
You're focused entirely on vega and theta.
Entirely. The long straddle is net positive vega. It desperately wants volatility to increase. The condor is net negative vega. It wants volatility to decrease or stay range-bound, and it profits primarily from positive theta decay.
And the warning today, January 15th, 2026, must be amplified regarding that 5E crush.
Absolutely. The play is on the macro uncertainty, not the immediate earnings reaction. If you execute a straddle today, you risk holding it through the immediate known IV crush event caused by those bank earnings.
Which could be devastating.
Benign reporting by GS, MS, or BLK could settle the entire global credit system, reducing the implied volatility premium across the board and destroying the value of your straddle overnight. You have to manage the timing.
And the iron condor.
The iron condor is slightly more resilient because it profits from the passage of time from theta, but still, an immediate rapid drop in vega is a massive headwind.
Yeah.
We need to be wary of the known volatility events and focus our trade on the lingering uncertainty, not the scheduled event risk.
So to summarize this entire deep dive for you, the listener, the Canadian housing crisis in 2026 is defined by two failures. The domestic 1% rate cut was a catalyst that failed to fix the core problem of unsustainable pricing and extreme leverage.
It was a Band-Aid on a bullet wound.
And the lingering systemic risk, the U.S. trade war and CUSMA are the ultimate vega risks that remain, warping all financial decisions. You are not trading underlying fundamentals. You are trading paralyzing economic fear and uncertainty.
That fear is what makes volatility the only efficient bet right now.
And the underlying cynical reality.
The cynical reality, confirmed by those 25-year sales lows in Toronto, is that real estate fails as a vehicle for options traders precisely because liquidity is king. When sentiment shifts, as it has so violently from FOMO to fear, the inability to liquidate quickly is the catastrophic hidden cost. The options market provides the vehicle to price that fear and execute with precision. Housing simply locks you in to bear the full brunt of the negative theta.
Okay, so this leaves us with one final provocative thought for you to consider as you digest this analysis and prepare your trade.
Yes. Robert Hove stated that the current slowdown in places like Toronto and southern Ontario is only a partial reversal of the massive, unsustainable post-COVID price surge.
Only partial.
So if that correction is merely partial, how much further in terms of structural percentage decline must major markets like Toronto and Vancouver fall before the correction is considered complete, before they are back to a price-to-income ratio that is actually sustainable?
And the follow-up question is even more important.
And perhaps more critically, because the financial health of the entire country is at stake. What happens to the systemic stability of the Canadian banking sector, which holds the vast majority of this leverage, when that true, necessary bottom is finally found and the negative gamma forces amplify the descent? That is the unknown floor you are trading against.